Bonds should lower overall volatility and should provide liquidity and all those properties that investors look for.
She explains why bonds should be back in investors' portfolios. Top portfolio manager Ellen Stanek is on Consuelo Mack WealthTrack.
Funding provided by ClearBridge Investments, Morgan Le Fay Dreams Foundation, First Eagle Investments, Royce Investment Partners, Matthews Asia, Strategas Asset Management, and Women Investing in Security and Education.
Hello and welcome to this edition of WealthTrack. I'm Consuelo Mack. How do you feel about bonds? Well, if you took most strategists' advice in recent years, WealthTrack guest Jeremy Grantham included, you would have shunned them. Interest rates had fallen to historic lows, pushing bond prices to historic highs. The two move inversely. As a result, bonds were dubbed the most expensive financial asset, the biggest bubble of them all. We are in the midst of a sea change. For most of the last 4 decades, bonds have been a superb investment. With a few notable exceptions, interest rates have been steadily declining since the early 1980s. That's when Fed Chairman Paul Volcker declared war on then rampant inflation. He hiked interest rates dramatically to suppress it and vanquished inflation until its recent return. With current Fed Chairman Jerome Powell promising to do what it takes to fight a 40-year high in inflation now, bonds have finally had their comeuppance. Bonds had their worst start to any year since data began in 1976. A 4-month stretch of declines sent the benchmark U.S. aggregate index down 9.5%. How do you manage through a cycle of rising interest rates and higher inflation? There aren't too many money managers who have that experience and have a track record of excellence through many different types of markets. This week's guest does. She is Ellen Stanek, Co-Chief Investment Officer of Baird Advisors and President of the Baird Funds, where she heads up the fixed income team. Stanek was recently named Morningstar's Outstanding Portfolio Manager of 2022 for her, quote, disciplined and risk-aware approach, thoughtfully navigating various market environments and generating impressive absolute and risk-adjusted returns in her 22 years at Baird. Stanek is lead portfolio manager of the Baird Aggregate Bond Fund rated 5-star Gold and Baird Core Plus Bond Fund rated 4-star Silver. Both funds have beaten their benchmarks since their inception in 2000 and in multiple years in between. I began the interview by asking Stanek about this new cycle of rising interest rates to combat inflation. Where are we?
Clearly, we have seen a dramatic change. When we step back over the last several years, we experienced very low inflation and very low nominal interest rates, then experienced a global health crisis, a forced economic shutdown, and a restart. And all through that, interest rates fell and spreads got very tight. And now we are seeing, the pendulum swinging. So to your direct question about where are we in this cycle, the bond market is telling us that the Fed is behind.
Right, and you feel that way. You feel that the Fed is, given inflation, where the inflation levels are, where they want to go, that the Fed has not been aggressive enough in addressing the inflation levels that we've got.
The Fed was trying to fight a potential battle of disinflation, deflation, and clearly interjected, now in hindsight, too much liquidity and eased too much, and then the quantitative easing on top of the easier monetary policy. So now we find ourselves on the flip side, where the Fed needs to begin a tightening cycle on a monetary policy basis, and then we will experience some shrinkage of the balance sheet or quantitative tightening. So all of that together has produced, in typical of the bond market, it got out ahead of the Fed. So today we find interest rates across the Treasury curve over 3%. They are now all over 3%, from the 2-year all the way out to the 30-year.
Huge change.
Very large change.
Enormous, yeah.
So to answer your question about where are we, well, the bond market has gotten out in front of the Fed and anticipated several interest rate hikes already and popped yields up. yield spreads have also started widening.
Right.
Corporate bonds and other spread sectors. So you're starting
Right.
to see nominal yields substantially higher. Keep your seatbelt on. The Fed is beginning their process, both on the monetary policy tightening as well as the quantitative tightening, and particularly the runoff or shrinkage of the balance sheet. But the market has anticipated a fair amount of that already, and we find ourselves today with higher yields. So we think while the Fed is in the earlier part of their cycle,
right,
the market is anticipating quite a bit. So the debate and dilemma today, and there are many cross currents, is does the Fed need to be even more aggressive and front load some decisions in the next several meetings to try to really attack and get at those rising inflationary expectations?
What do you think about thoughts and speculation like that?
The belief based on the latest consumer price index information and that inflationary data coming through, it remains running very strong, is that they are going to potentially need to be more aggressive in these earlier meetings in 2022, and particularly their rhetoric will need to sharpen. And remember, that's what they're trying to do, is hit really and slow inflationary expectations. If you believe that inflation is high and going to stay high or rise even further from here, it will cause you to behave differently potentially. So market participants are caught, right? We've used the analogy in the past of lemons versus lemonade. The lemons part is you see the bond market rising and anticipating the rise in interest rates and moving market yields aggressively up. The lemonade for investors is that from here forward, you look at the yield on your portfolios and they are more attractive for sure than they had been, just a year or so ago.
Right.
So we've had a pretty significant move.
The lemon part of that, of course, is as yields get more attractive, bond prices go lower.
They
so
go
if you're
lower.
holding bonds, yeah,
right,
that's a dilemma, which we'll get to in a minute. But I want to just follow up on the Fed needs to show resolve.
Right.
And so the question is, if the Fed needs to tighten a lot more aggressively, how can we avoid recession?
One of the pieces of data that was just reported was consumer sentiment, and consumer sentiment dropped very dramatically. And so the consumer, of course, is about 70% of real GDP. So
right,
when sentiment drops a lot, that is certainly of concern. So the probabilities that we will experience a recession sometime over the next year plus are certainly rising. So could we see, a quarter or two of negative real GDP?
Mm-hmm.
Yes, we could see a softening in economic growth. It would be a very likely outcome in here.
You got into the business in, 1979, just as Paul
Correct.
Volcker was taking over and
yes,
ratcheting up interest rates, and he caused a pretty severe recession.
Very severe.
It's a whole different ballgame now for bond managers. What are you telling your younger teammates about what to expect and how to manage in a market like this, which is something they have never experienced?
Yes. So over the 40-year period of time, certainly it has not been only one direction.
No.
There have been a lot of bouts of volatility. And fortunately, our approach to managing bond portfolios is a hybrid that is not dependent on trying to time interest rates. So when you look at our long-term track records, they were built not by trying to anticipate interest rates and moving duration around, but all those other things we do to add value: yield curve positioning, sector allocations, underweights and overweights, and individual security selection. And so what we encourage our teammates, all of us, even the experienced veterans is to stay focused. Stay focused on, for units of risk, are we being paid to take on that risk? Whether it be spread, additional spread risk in terms of as we venture beyond the treasury market, and are we, always calibrating that risk return variable? While you don't wish the last couple of years on anyone,
right,
it has been a great living, learning laboratory for all of us, but particularly younger talent. Because there are points in time where investing, it is not very clear and it can be very foggy. And there's right now, frankly, a lot of cross currents. And so you can, as an investor, get caught up in all that noise, or you can stay focused on, if you're a credit analyst, all right, let's go look at the fundamentals. Let's stress test this sector. Let's think about how this company's going to weather the storm. Let's think about where on the yield curve I want to own that bond. There's a whole number of things. Unfortunately, our style is such that at the same time, they're not trying to swing for the fences and try to make really big interest rate calls and move duration around and try to add value that way. Others try to do that. We don't believe in that approach. Ours is really a hybrid of a passive. The passive nature of what we do is that duration or interest rate neutrality to the portfolio's benchmark. But the active part of what we do is all those other building blocks to add the value.
In a previous interview, I loved a couple of things that you said. One is that you don't want to be exciting.
Yes.
And the other one was that a client actually said that he or she viewed the Baird bond funds as sleep insurance. You said that was a compliment.
It was a badge of honor. So
yeah,
there have been a few restless nights more recently with the volatility. But it is, bonds should lower overall volatility and should provide liquidity and all those properties that investors look for. And so, yes, that is really what we strive to do. Is we can't completely avoid the underlying volatility in the capital market itself. Mm-hmm. Effectively, foundationally, we just believe in the efficiency of the bond market itself. And that over time, it will discount risk and return and provide and pay investors appropriate risk-adjusted returns. What ends up emotionally freeing us in so many ways is this approach that we use. We're not trying to get the crystal ball out and make these big top-down decisions. We have macro viewpoints about what we think is happening, but we're not trying to bet the ranch and try to drive returns that way. Because if in the bond market, and particularly investing in this asset class, if you're wrong, the cost of being wrong is very, very significant. Mm-hmm. We love our baseball analogies. We don't try to hit home runs because we don't want to strike out. It's too painful in this asset class. So we try to hit a lot of singles. We'll take a walk, hit by a pitch, whatever gets us on base, and have very high batting averages. And ironically, the more volatile the market environment, to take it back to today, the more volatile and uncertain the market environment, generally the more opportunities that appear for a manager like ourselves who's looking at these relative relationships and trying to capitalize on them and take a basis point here, a basis point there. They might be what others would think are small little decisions. We do enough of them, and that's how over time we've been able to drive the returns net of the cost to invest.
So where are you seeing opportunities now, Mary Ellen, and is it going to be different tomorrow? Is the market, changing so rapidly? What used to be considered a stable market that's no longer the case. So where are you seeing opportunities now, and can you make generalities?
Yes. So generally, now the yield curve has gotten very flat. So again, the
Right, the difference between short and long term.
Short and long, they're all over 3% now on the longer end.
Right, so that is flat. There's not a lot of difference
Very
among
flat.
them. Right.
So what that gives you is an opportunity to earn yield without having to go out very far on the yield curve. And
so you can go shorter maturity to get the same, basically the same kind of yield or close to that you would have to go out buying a longer bond, a longer maturity bond.
Our preference generally for the portfolios is short to intermediate with particularly our spread sectors. And that's where we find some great opportunity. As we go down in credit quality, still investment grade, we own smaller position size per name. It's a great buffer or diversification view. Diversification matters and aids portfolio returns and lowers overall volatility. To your question about what tomorrow brings, I think one of the benefits, and you alluded to it earlier, I started my career in 1979, right in front of when Paul Volcker took interest rates and took them to well over, you saw commercial paper rates over 20%. And another analyst and I were brand new. In fact, the more seasoned players on the team dubbed us the bear market babies. When you start your career into what, at least so far, has been the worst bear market in bonds, it shapes you. It shapes how you think about risk. It shapes in terms of how you see opportunity. And through all of that, I learned a lot. And hopefully, we're able to impart that with our younger talent, to your question before about how you help coach, engage, lead teams through this, and to continue to encourage them to stay focused on what matters. And we think a lot about aligning the interests of our investors with our firm, with our team, with the incentives, how we make decisions, that we keep it elegantly simple with that investor in mind, and over time try to pay for ourselves, the cost to invest, but then deliver something additional for investors. And generally, we like more volatile market environments because when others are selling to get out of the way or buying because now they're on the wrong side of a duration call, they create opportunity. They're not worried about that last half of a basis point or the quarter here or the quarter there. We are, and we're able to come in and provide liquidity and add value in our portfolios.
Wall Street strategists, as you know, for the last several years have been telling investors that bonds are in a bubble, that they are the most expensive asset class, that you really shouldn't be involved in bonds, at all. And it driven investors into stocks. The acronym TINA, there is no alternative. That was because interest rates were so low. Are they still expensive?
No, bonds, the relative value positioning of bonds versus other asset class, particularly equities, has changed. And to your point, there are many very highly regarded strategists. One who I'm privileged to work with, as it's a Baird-owned company. And
Jason Trenner at Strategas. Absolutely.
At Strategas, who we think very, very highly of Jason and his
WealthTrack guest
team
many times.
and their work, but they're looking at nominal returns on equities in the single-digit range. Well, when you start looking at where yields are on these bond portfolios now, it's getting actually quite competitive and compelling. And in fact, one of the best ideas we have for taxable investors is high-quality munis, particularly when you tax adjust those yields. And if you happen to be a taxpayer in New York or California, those yields are now in that 7 to 8% range, tax adjusted. So to your point, to the TINA argument that there wasn't an alternative, well, bonds are back and they are more compelling. Will they get even more compelling? Maybe. And the final thing I would say is over the last many years, probably at least a decade, we have seen investors, some of them following those strategists' advice, or asset allocators who have brought down core investment grade rated allocations to the lowest levels we have seen in our careers. So as rates are rising at the margin, it's starting to tip. We think once the market settles a bit in here, we think it will tip money back in towards bonds.
In a Morningstar interview, Mary Ellen, you said that liquidity, especially in a crisis, that liquidity is incredibly important. And you mentioned earlier that you actually, one of the services that you provide to investors is you want to provide them liquidity. How do you do that?
Actually, investors, whether they invest with us and use our bond portfolios for their bond positions or they're doing individual bonds themselves, typically they will have layers of liquidity, and cash is the ultimate liquidity vehicle. Our portfolios carry a little bit of cash. Treasuries are very liquid. Typically you could sell treasuries on the bid side of the market and the execution is actually quite good. After that, typically it's asset-backed, AAA rated asset-backed securities. Certainly many of the securitized, the AAA rated mortgage-backed securities. So you start layering and you can have many sectors and a large portion of your portfolio that is relatively or readily liquid. But liquidity into a crisis is number 1, 2, and 3. Make sure you really understand how liquid your portfolio is and that you will never be in a position of being a forced seller.
The last time you were on a couple of years ago, your one investment for a long-term diversified portfolio was small cap stocks, a well-diversified, top quality small cap stock fund. It's a very different environment now. What would your recommendation be today?
I ran into our SMID growth. It was our annual meeting yesterday, and I ran into our SMID growth portfolio manager.
Right, small to mid cap growth.
Small to mid cap growth, and I mentioned that my recommendation had been a general recommendation. So we talked about that certainly valuations have gotten more compelling. But this might surprise you, and certainly I do believe those higher growth rates that portfolios and investors who do have very long time horizons should take advantage of that. But given market conditions today, what is really compelling when we look at the municipal bond market, again, for a lot of your audience are taxpayers, obviously, and when you look at where the muni market is today, in particular, and you look out in that 10 to 15 year AA area, you've got a 4% yield now. And then you tax adjust that, and it's close to 7%. Wow. And then if you look at for New York and California taxpayers, you're getting in that 8% effective range. That over time is tough to compete with, particularly for a portion of your portfolio that can be your foundation. So, and then what's also interesting in the municipal market is coming through the pandemic, state, local municipals made the case strongly to the federal government that they were worried about their own fiscal health. And so they disproportionately received a lot of support. And so California right now has something like a $98 billion budget surplus. Texas, $24 billion. Texas, I mean, it's way beyond rainy day funds at this point. So from a fundamental vantage point, these municipal markets about as solid as it could be. So that would be my one recommendation for taxable investors. Take a look, and again, it's that foundational piece for longer term portfolios.
Mary Ellen Stanek, such a treat to have you on. Congratulations on the Morningstar Award. It's really terrific, and given your performance, you definitely, and your team's performance, you definitely deserve it.
Thank you. It was just an enormous recognition of the team. Really grateful for that.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's Action Point borrows some advice from Mary Ellen Stanek, who emphasized how important liquidity is in her portfolios, especially in times of crisis. So this week's Action Point is pay attention to liquidity in your portfolios. Cash and equivalents are the most obvious choices to both cushion the portfolio against market declines and have funds to invest during them. But in the investments themselves, having some high-quality funds or securities identified ahead of time can also provide some financial and psychological comfort. Stanek calls her bond fund sleep insurance. It's a concept that should be part of every portfolio. Well, next week, the antithesis of sleep insurance. Crypto expert Matt Hogan brings us up to date on the future of cryptocurrency investments. In this week's extra feature, Mary Ellen Stanek explains Baird's servant leadership approach and why it is paying big dividends at the firm. We invite you to follow us on Facebook, Twitter, and our YouTube channel. Thank you for watching. Have a wonderful Father's Day weekend and make the week ahead a healthy, profitable, and productive one.